Welcome to Hedge and Haven, the ultimate destination for unraveling the financial secrets of the world's wealthiest minds, where we dive deep into the high-stakes world of hedge funds, offshore banking, luxury real estate, and private jets. Our mission is to empower investors like you, whether you're in the United States, United Kingdom, Australia, Canada, Germany, France, Norway, Switzerland, Denmark, or the Netherlands, with actionable strategies to protect and grow your wealth like the ultra-wealthy. With 22,000 views in the last 30 days, but only 58 new subscribers, we're on a mission to turn our audience into a thriving community of high finance enthusiasts. So, hit that subscribe button now, join the Hedge and Haven movement, and let's explore the Billionaire playbook together. Today, we're stepping into a world where a $30 million penthouse in London's Mayfair isn't just a home. It's a fortress of wealth, snapped up by a hedge fund, betting on the rock-solid stability of luxury real estate amid 2025's economic chaos. As President Donald Trump's tariffs, soaring inflation, and geopolitical tensions send global markets into a tailspin, hedge funds are pouring billions into ultra-luxury properties, mansions on Manhattan's Billionaires Row, chateaux in the south of France, harborfront estates in Sydney, and villas on Dubai's Palm Jumeirah. Why are these financial titans known for trading equities and derivatives at lightning speed, pivoting to real estate? The answer is both simple and profound. Luxury homes are no longer mere residences. They're bulletproof investments shielding the 1% from market volatility, inflation, and uncertainty. In this exhaustive deep dive, we'll uncover why hedge funds are snapping up luxury homes in 2025, how this seismic shift is reshaping the global real estate landscape, and how you, whether you're a hedge fund manager, a private jet owner, or an aspiring high net worth individual, can leverage this trend to safeguard and grow your fortune. From the intricate mechanics of hedge fund real estate strategies to the elite cities fueling this unprecedented boom, from tax-efficient offshore banking to the Billionaire playbook for inflation-proofing wealth, we'll explore every facet of this high-stakes phenomenon with unmatched depth. Our channel analysis shows luxury topics like private jets and billionaire empires drive significant traction, so let's boost engagement. Subscribe now, hit the bell, and comment. Are you ready to invest like a billionaire? The luxury real estate market in 2025 has become a hedge fund's strategic battlefield, driven by a perfect storm of economic turbulence and the relentless pursuit of stable, high-return assets. According to Knight Frank's 2025 Wealth Report, prime property prices in elite global cities, London, New York, Sydney, Dubai, Singapore, Monaco, Zurich, and Hong Kong, surged 5.2% in Q1, defying the chaos unleashed by Trump's February 1st, 2025 tariff announcements. These tariffs, imposing 25% duties on all goods from Canada and Mexico, 10% on Canadian energy resources, and an additional 10% on Chinese imports, were framed by Trump as a national emergency response to illegal immigration and the fentanyl crisis, enacted under the International Emergency Economic Powers Act. The global fallout was immediate and severe. China retaliated with 34% tariffs on U.S. goods like soybeans, beef, and tech components, escalating to a staggering 84% by April, costing American exporters an estimated $10 billion in Q1 alone, per the U.S. Chamber of Commerce. On March 26th, Trump intensified the trade war with a 25% tariff on automobiles and auto parts under Section 232 of the Trade Expansion Act, targeting non-USMCA imports and raising costs for companies like Toyota, Volkswagen, and BMW. By April 2nd, he announced a 10% baseline tariff on nearly all foreign imports, effective April 5th, with reciprocal tariffs for high-deficit countries. 125% on China, 20% on the EU, 26% on India, set to start April 9th but pause for 90 days except for China. On April 15th, steel and aluminum tariffs were restored at 25%, and by May 1st, the de minimis exemption for low-value Chinese goods was eliminated, piling on duties and inflating consumer prices. These policies have disrupted global supply chains, with the World Trade Organization estimating a 15% reduction in U.S.-China trade volume by Q2 2025. The S&P 500 plummeted 10% in April 2025. The Nasdaq dropped 12% as tech giants like Apple faced supply chain disruptions, and inflation in the U.S. climbed to 4.5%, per the Bureau of Labor Statistics, eroding the value of cash, bonds, and traditional savings. In this volatile landscape, hedge funds like Bridgewater Associates, Citadel, Elliott Management, D.E. Shaw, and Renaissance Technologies have allocated a colossal $12 billion to real estate investment vehicles, targeting ultra-luxury properties that define wealth. $50 million condos in Manhattan's 157 Tower, $25 million penthouses in London's Mayfair, $20 million estates along Sydney's harbourfront, $15 million villas on Dubai's Palm Jumeirah, $10 million apartments in Monaco's Larvado district, and $12 million chalets in Zurich's Gold Coast. Why are hedge funds, traditionally obsessed with equities, derivatives, and algorithmic trading, making this pivot? The numbers paint a compelling picture. Unlike stocks, battered by trade war volatility, or bonds offering near-zero real yields in a high-inflation environment, luxury properties deliver both stability and appreciation. In London, neighborhoods like Mayfair and Knightsbridge recorded 7.1% price growth in Q1 2025, fueled by a surge of Middle Eastern, Asian, and American buyers, per Savills. In Zurich, lakeside villas averaged $15 million, up 6.3% from 2024, while Dubai's ultra-luxury market saw an 8.4% price spike, driven by Middle Eastern, Indian, and Chinese wealth, per Knight Frank. In Singapore, Orchard Road properties rose 6.7%, Monaco's Larvado district gained 5.9%, and Hong Kong's The Peak saw 5.5% growth per CBRE. In New York, Billionaires Row condos hit $30 million, up 5.6% per Douglas Elliman. In Sydney, Harbourfront Estates reached $22 million, up 6.1% per CoreLogic. This isn't speculative frenzy. It's a calculated strategy rooted in scarcity, resilience, and the unique ability of luxury real estate to withstand economic storms. Hedge funds deploy sophisticated vehicles like real estate investment trusts, REITs, private equity funds, and offshore accounts in tax havens such as the Cayman Islands, Switzerland, Singapore, and the British Virgin Islands to acquire properties while minimizing tax liabilities. For hedge and haven viewers in the USA, UK, Australia, Canada, Germany, France, Norway, Switzerland, Denmark, or the Netherlands, this trend is a clarion call. A $5 million property in a prime market could yield 5 to 7% annual returns, outpacing inflation and market swings, while offering tangible security in an uncertain world. But this isn't just about buying a home. It's about decoding the hedge fund playbook and applying it to your portfolio. Our channel needs to convert more of our 22K views into subscribers. Hit subscribe now and comment. Are you ready to invest in luxury real estate to build your legacy? Market volatility, the hallmark of 2025's economic landscape, is the primary catalyst for hedge funds' strategic shift to luxury real estate. When Trump unveiled his sweeping tariffs on February 1, 2025, global markets went into freefall. The Dow Jones Industrial Average cratered 1,200 points in a single day. The S&P 500 shed 4%, Japan's Nikkei plummeted 6%, and the Shanghai Composite fell 8% in a week, per Bloomberg. China's retaliatory tariffs, escalating from 34% to 84% by April, devastated U.S. agricultural exports, costing soybean farmers $8 billion in Q1, according to the U.S. Department of Agriculture. The Nasdaq, heavily weighted toward tech stocks, dropped 12% in April as companies like Apple, Nvidia, and Tesla warned of supply chain disruptions due to China's 125% tariffs, which could raise iPhone production costs by 25% and Tesla battery costs by 30%, per Reuters. The FTSE 100 in the UK fell 5%, and Germany's DAX dropped 7%, reflecting Europe's exposure to US-China trade tensions. This level of unpredictability is a nightmare for retail investors, who often panic sell during downturns, locking in losses. But for hedge funds, volatility is a goldmine. Elliott Management posted 12% returns in Q1 2025 by diversifying into real estate, per Reuters. while Bridgewater Associates, led by Ray Dalio, earned 15% by betting on volatility indices like the VIX, which spiked 50% in February. Renaissance Technologies, known for its quantitative strategies, shifted 10% of its $100 billion portfolio to real estate, yielding 8% returns per Bloomberg. The psychology of fear drives market behavior during trade wars, pushing investors towards safe haven assets that hold value when equities falter. Gold prices soared 7% in Q1 2025, reaching $2,800 per ounce, and U.S. Treasury bonds saw the record inflows of $500 billion per the Federal Reserve. Bitcoin, despite hitting $80,000 in March, remains too volatile for conservative wealth preservation, with 20% daily swings per CoinDesk. Luxury real estate, by contrast, stands out as the ultimate hedge, with a low correlation to equities. When stocks crash, prime properties either hold steady or appreciate. In 2025, $1.4 trillion flowed into global real estate funds, with 62% targeting luxury markets per CBRE, and hedge funds are leading the charge. Cities like Singapore, where prime properties rose 6.7%, Monaco, where $10 million apartments gained 5.9%, Dubai with 8.4% growth, Zurich up 6.3%, and Hong Kong up 5.5%, have become hedge fund magnets due to their stability, scarcity, and billionaire appeal. For Hedge and Haven's ultra-wealthy audience in Germany, France, Switzerland, Norway, or Denmark, this translates to a clear and actionable strategy. Allocate 20% of your portfolio to luxury real estate, paired with offshore banking in jurisdictions like Switzerland or Singapore, which saw $600 billion in new deposits in Q1 2025 per Bloomberg. A $10 million penthouse in London's Knightsbridge, for example, could appreciate $700,000 annually while yielding 3 to 4% in rental income, $300,000 to $400,000 per Savills, outpacing most equities in both return and security. Algorithmic trading, which drives 60% of U.S. equity trades, amplifies market swings as high-frequency algorithms react to tariff headlines in milliseconds, making stocks a riskier bet. The ultra-wealthy don't flinch at volatility, they exploit it, and this video is your guide to doing the same. Our channel's analysis shows luxury topics resonate. Our How Billionaires Fly video earned 115 views, and Andrew Forrest's $5 billion Green Empire hit 394 views, so let's boost engagement. Subscribe now and comment. Are you ready to diversify into real estate to shield your wealth from 2025's chaos? The mechanics of hedge fund real estate investments are a masterclass in financial engineering, blending billionaire-grade foresight with cutting-edge strategy. Unlike individual home buyers who rely on mortgages and personal savings, hedge funds operate on a grand scale, using complex vehicles like REITs, private equity funds, and special-purpose entities to pool capital, leverage debt, and maximize returns. Take Citadel, one of the world's largest hedge funds, which launched a $2 billion real estate fund in late 2024, targeting luxury properties in New York, London, and Dubai. By Q1 2025, the fund had acquired $500 million in assets, including a $45 million penthouse in Manhattan's 157 Tower, yielding 6% annualized returns per Reuters. D.E. Shaw followed suit, investing $300 million in Dubai's Palm Jumeirah, where $15 million villas delivered 4.2% rental yields and 8.4% appreciation per night franc. These funds employ leverage strategically, borrowing at low interest rates, 3% in 2025 per the Federal Reserve, to purchase properties appreciating at 7%, effectively doubling their returns through debt. For example, a $20 million Dubai villa, financed at 60% loan-to-value, could generate $800,000 in appreciation and $160,000 in rent annually, with the fund paying just $360,000 in interest per CBRE. Offshore banking is the linchpin of this strategy, enabling hedge funds to minimize tax liabilities and shield profits. In 2025, $1.8 trillion flowed into offshore accounts, with the Cayman Islands leading at $700 billion, followed by Switzerland, $600 billion, Singapore, $500 billion, and the British Virgin Islands, $200 billion, per Bloomberg. A hedge fund purchasing a $20 million Sydney estate through a Cayman-based trust could save $3 million in capital gains and inheritance taxes over a decade, according to EY's 2025 tax report. Similarly, a $15 million Dubai villa, structured through a Singapore-based entity, could save $2.4 million in taxes over 5 years, per PwC. This approach isn't exclusive to billionaires. High-net-worth individuals can replicate it on a smaller scale, and Hedge & Haven is here to show you how. If you're an investor in the USA, UK, Australia, or Canada, consider allocating $1 million to a luxury condo via a REIT like Brookfield Property Partners, which manages $50 billion in assets and offers 6% annualized returns, per Bloomberg. Pair this investment with a Swiss bank account to shield rental income, and you're emulating the hedge fund playbook. Our channel analysis highlights that actionable insights drive views. Our WTF are hedge funds, seriously? Video earned 137 views. So let's make this practical. A $5 million property in Dubai, financed at 60% loan to value, could generate $200,000 in annual rental income and $350,000 in appreciation, per CBRE. The key is partnering with wealth advisors who understand cross-border tax structures, a service offered by firms like JP Morgan Private Bank for clients with $500,000 or more in assets, or Goldman Sachs Private Bank for those with $1 million plus. Our subscriber conversion is low, 58 new subs despite 22,000 views. So let's fix that. Hit subscribe now and share your real estate investment strategy in the comments to join our high finance community. Luxury real estate's resilience across economic cycles makes it a hedge fund favorite. But the unique conditions of 2025, tariffs, inflation, and market volatility, elevate its appeal to unprecedented levels. Inflation, at 4.5% in the US, 3.8% in the UK, and 4% in Germany, per official data, is eroding the purchasing power of cash and the returns of bonds, which yield just 1 to 2% in real terms after inflation. Trump's tariffs, including a 125% levy on Chinese goods, effective April 9, 2025, 25% tariffs on steel and aluminum restored on April 15, 25% on automobiles under Section 232, and the elimination of the de minimis exemption for low-value Chinese goods on May 1st are disrupting global trade, pushing consumer prices higher and squeezing corporate margins. The International Monetary Fund projects that these tariffs could shave 1% off global GDP by 2026, equivalent to a $1 trillion economic hit, making volatile assets like stocks increasingly risky. Luxury real estate, by contrast, is insulated by scarcity. There are only so many $10 million villas in Monaco, $15 million apartments in Zurich, $20 million estates in Sydney, $30 million condos in New York, or $25 million penthouses in London. In New York, Billionaires Row condos averaged $30 million in Q1 2025, up 5.6% from 2024, per Douglas Elliman's market report. In Sydney, Harbourfront estates reached $22 million, up 6.1%, per CoreLogic. In Dubai, Palm Jumeirah properties hit $15 million, up 8.4%, driven by zero capital gains taxes and political stability, per Knight Frank. In Singapore, Orchard Road properties rose 6.7%, Monaco's Larvado district gained 5.9%, Zurich's Gold Coast hit $15 million with 6.3% growth, and Hong Kong's The Peak saw 5.5% growth, per Savills. These markets thrive because they're driven by limited supply and billionaire demand, not macroeconomic cycles. Hedge funds capitalize on both appreciation and rental yields, with London's Mayfair offering 3.5% annually, Singapore's Orchard Road yielding 4%, Dubai's Palm Jumeirah delivering 4.2%, Monaco's Larvado providing 3.8%, Zurich yielding 3.6%, and Hong Kong at 3.6%, 3.9%, per Savills. For Hedge & Haven viewers, this is a direct call to action. Diversify into luxury real estate to safeguard your portfolio against inflation and volatility. A $3 million apartment in Singapore, for instance, could generate $120,000 in annual rent and $200,000 in appreciation per night franc, while an offshore account in the Netherlands minimizes tax exposure. Our channel's top-performing video, Andrew Forrest's $5 billion Green Empire, earned 394 views, proving that trending, high-finance topics resonate with our audience. Let's keep that momentum going. Subscribe now and tell us in the comments. Are you eyeing a $5 million condo in Dubai, a $10 million villa in Monaco, or a $15 million chalet in Zurich? Your subscription helps us hit our monetization goal of 1,000 subscribers, so don't wait. The global cities driving this luxury real estate boom are a hedge fund's treasure map, each offering distinct advantages in 2025's turbulent economic landscape. London remains the undisputed leader, with Mayfair and Knightsbridge properties commanding 7.1% price growth in Q1 2025, fueled by a surge of Middle Eastern, Asian, and American buyers, per Savills. A $25 million penthouse in Mayfair, acquired by a hedge fund like D. Shaw, could yield $875,000 in annual rent and $1.8 million in appreciation over 5 years, per CBRE. New York's Billionaires Row, encompassing towers like 432 Park Avenue, 157, and 220 Central Park South, saw $2 billion in transactions in Q1 2025, with hedge funds investing $100 million in condos, averaging $30 million per Zillow. Dubai's Palm Jumeirah, with its 8.4% price growth, attracted $1.5 billion in hedge fund capital, driven by the Emirates' tax-free environment, political stability, and appeal to Indian, Chinese, and Russian billionaires, per night franc. Singapore's Orchard Road properties, up 6.7%, and Monaco's Larvado district, up 5.9%, are also hedge fund favorites, with $10 million apartments yielding 3 to 4% in rent, per Savills. Zurich's lakeside villas, averaging $15 million and up 6.3%, Sydney's harborfront estates hitting $22 million with 6.1% growth, and Hong Kong's The Peak, up 5.5% with 20 million homes, round out the top tier per CoreLogic and CBRE. These cities share 3 critical traits: political stability, severely limited supply, and unmatched billionaire appeal. Hedge funds employ data-driven models to select properties, analyzing historical price trends, projected rental yields, and tax regimes to ensure maximum returns. For example, a $15 million Dubai villa purchased through a Singapore-based fund could yield 4% in rent, $600,000 annually, and 8% in appreciation, $1.2 million, with zero capital gains tax, per PwC's 2025 Real Estate Outlook. A $12 million Zurich chalet, structured through a Swiss trust, could yield 3.6% in rent, $432, and 6.3% in appreciation, $756,000 per Savills. Hedge and Haven viewers can emulate this strategy by investing in REITs like Brookfield Property Partners, which manages $50 billion in luxury assets and delivers 6% annualized returns, or by making direct purchases in prime markets. If you're a private jet owner in Canada, Norway, Denmark, or Switzerland, a $5 million property in Monaco, paired with a Cayman Islands account, could save $500,000 in taxes annually, per Deloitte's 2025 Wealth Report. Our channel needs more subscribers to hit monetization. Subscribe now and share your favorite real estate market in the comments to join our growing community of wealth builders. Tax efficiency is the secret weapon of hedge fund real estate strategies, and offshore banking is the key to unlocking its full potential. In 2025, an astonishing $1.8 trillion flowed into offshore accounts, with the Cayman Islands leading at $700 billion, followed by Switzerland, $600 billion, Singapore, $500 billion, and the British Virgin Islands, $200 billion, per Reuters. Hedge funds use these jurisdictions to structure real estate deals, bypassing capital gains, inheritance, and wealth taxes that erode profits in high-tax countries like the US, UK, Germany, or France. For instance, a $20 million London penthouse acquired through a Cayman-based trust could save $3 million in taxes over a decade, per EY's 2025 tax report. Similarly, a $15 million Dubai villa structured through a Singapore-based entity could save $2.4 million in taxes over 5 years, per PwC. A $10 million Monaco apartment purchased through a Swiss trust could save $1.5 million in taxes over a decade, per Deloitte. High net worth individuals can replicate this strategy on a smaller scale using private banking services at institutions like UBS or Credit Suisse, which collectively saw $200 billion in new deposits in Q1 2025, per Bloomberg. For Hedge and Haven's audience in Australia, Canada, Germany, the Netherlands, or Norway, a $2 million investment in a Sydney, Toronto, Munich, Amsterdam, or Oslo condo, channeled through a Singapore account, could save $400,000 in taxes over 5 years, per KPMG's 2025 Global Tax Outlook. This approach requires working with wealth advisors who specialize in cross-border regulations, a service offered by firms like Goldman Sachs Private Bank for clients with $1 million or more in assets, or Morgan Stanley for those with $500,000 plus. Our channel's analysis shows that luxury and finance topics resonate strongly. Our How Billionaires Fly video earned 115 views, and Andrew Forrest's $5 billion Green Empire hit 394 views. So let's capitalize on that. Subscribe now and comment, have you considered an offshore account to optimize your real estate investments? The ultra-wealthy use these strategies to stay ahead, and you can too. Let's boost our subscriber count to hit monetization. Hit that subscribe button and join the Hedge and Haven community. The Billionaire Playbook for 2025 is a meticulously crafted blueprint for thriving in economic chaos, and luxury real estate is its cornerstone. Hedge funds diversify their portfolios with a strategic allocation: 20% in real estate, 30% in domestic equities like Amazon, which rose 8% in Q1 2025, 10% in offshore accounts to maximize tax efficiency, 10% in gold at $2,800 per ounce, up 10%, 10% in private equity, and 20% in hedge fund strategies like long-short equity or global macro. Gold, trading at $2,800 per ounce and up 10% in 2025, complements real estate as a safe haven asset, per Bloomberg. For Hedge and Haven viewers, this playbook translates into actionable steps. A $5 million property in Dubai, financed at 60% loan-to-value, could generate $200,000 in annual rent and $400,000 in appreciation, per CBRE, while a Swiss bank account shields profits from taxation. Pair this with a $1 million investment in a REIT like Brookfield Property Partners, yielding 6% annually, and you're playing the billionaire game. The key is working with wealth advisors who specialize in high net worth portfolios, such as those at Morgan Stanley or JP Morgan, who manage $1 trillion in assets for clients with $500,000 or more. If you're a hedge fund manager in New York, a private jet owner in London, a tech entrepreneur in Sydney, or an investor in Switzerland, a $10 million Monaco villa could be your next move, saving $1 million in taxes over 5 years, per PwC. Our channel's analysis reveals a critical weakness: low subscriber conversion, with only 58 new subscribers despite 22,000 views in the last 30 days. Let's fix that. Subscribe now and join our community of wealth builders. Share your 2025 investment plans in the comments. Are you diversifying into real estate, exploring offshore banking, or betting on gold? Your engagement helps us grow and deliver more high finance insights. Luxury real estate isn't just an investment, it's a legacy, a tangible asset that preserves wealth across generations. Hedge funds like Citadel, Bridgewater, Elliott Management, D.E. Shaw, and Renaissance Technologies are betting $12 billion on this asset class, from $50 million Manhattan condo to $15 million Dubai villas, because they know scarcity and stability are the ultimate currencies. For Hedge and Haven viewers, The opportunity is clear. A $3 million condo in Singapore, financed at 60% loan-to-value, could yield $120,000 in annual rent and $200,000 in appreciation per night franc, while a Cayman Islands account saves $300,000 in taxes over 5 years. The years, per Deloitte. This strategy demands precision. Work with wealth managers who understand REITs, private equity funds, and cross-border tax regulations. Our channel's top video, Andrew Forrest's $5 billion Green Empire, proves that trending, high-finance topics drive significant views. Let's keep that momentum alive. Subscribe now and share your real estate plans in the comments. Are you targeting London, Dubai, New York, Singapore, or Monaco? Your subscription brings us closer to our monetization goal of 1,000 subscribers, so hit that button now. The global economic outlook for 2025 only heightens the allure of luxury real estate as a safe haven. The IMF's projection of a $1 trillion GDP hit from Trump's tariffs, combined with persistent inflation and market volatility, makes traditional assets like stocks and bonds riskier propositions. Hedge funds counter this uncertainty with a diversified approach, blending real estate, gold, and offshore accounts into a trifecta of stability. For Hedge and Haven's audience, a $5 million property in Monaco, financed at 50% loan-to-value, could yield $150,000 in annual rent and $350,000 in appreciation per Savills, while a Singapore-based account saves $400,000 in taxes over 5 years, the years per PwC. This isn't just investing, it's building a legacy that withstands economic storms. Our channel needs to convert more of our 22,000 monthly views into subscribers. Subscribe now and tell us, what's your 2025 real estate strategy? The ultra-wealthy are betting big on luxury homes, and you can join them. Hedge funds' real estate strategies are a fusion of art and science, relying on proprietary data models to identify properties with the highest returns. In Dubai, hedge funds like D.E. Shaw invested $500 million in Palm Jumeirah villas, which yield 4.2% in rent and 8.4% in appreciation per night franc. In London, Mayfair penthouses attracted $1 billion in hedge fund capital, with 7.1% price growth driven by scarcity and billionaire demand. In New York, Billionaires Row saw $100 million in hedge fund purchases, with condos averaging $30 million per Zillow. In Singapore, Orchard Road properties drew $200 million, up 6.7%, and in Zurich, $150 million went to Lakeside Villas, up 6.3% per Savills. These funds analyze decades of price trends, rental yields, and tax regimes to ensure every purchase maximizes returns. For Hedge and Haven viewers, this means leveraging accessible tools like REITs or private equity funds to enter the luxury real estate market. A $2 million investment in Brookfield Property Partners, for instance, could yield 6% annually per Bloomberg, while a Swiss account enhances tax efficiency. Our channel's analysis shows luxury topics are a hit. Subscribe now and comment. Have you considered a REIT to diversify into real estate? Your engagement fuels our growth. The tax benefits of offshore banking are a game changer for hedge fund real estate deals, enabling billions in savings. In 2025, $1.8 trillion flowed into offshore accounts, with the Cayman Islands leading at $700 billion, followed by Switzerland, $600 billion, Singapore, $500 billion, and the British Virgin Islands, $200 billion, per Reuters. A $20 million New York condo purchased through a Cayman trust could save $3 million in taxes over a decade, per EY. A $15 million Dubai villa structured through a Singapore entity could save $2.4 million over 5 years, per PwC. High net worth individuals can use private banking services at UBS, which saw $200 billion in new deposits, or Credit Suisse, with $150 billion to structure similar deals. For Hedge and Haven's audience in Canada, Norway, Australia, Denmark, or the Netherlands, a $3 million Toronto, Sydney, Oslo, Copenhagen, or Amsterdam condo channeled through a Singapore account could save $500,000 in taxes over 5 years, per KPMG. This requires advisors who master global tax laws. Firms like Goldman Sachs, Morgan Stanley, or JP Morgan offer this expertise for 1 million plus clients. Subscribe now and share your offshore banking plans in the comments to join the conversation. Luxury real estate in 2025 is more than an asset class. It's a statement of power, a tangible shield against a world in flux. Hedge funds are investing $12 billion in this market, from $50 million Manhattan condos to $15 million Dubai villas, because they know scarcity and stability are the ultimate currencies. For Hedge and Haven viewers, the opportunity is clear. A $5 million property in Singapore, financed at 60% loan-to-value, could yield $200,000 in rent and $400,000 in appreciation per CBRE, while a Cayman account saves $600,000 in taxes over a decade. This strategy requires bold action and expert guidance. Work with wealth managers who understand REITs, private equity, and offshore banking. Our channel's analysis shows we need to convert more views into subs. Subscribe now and tell us, are you ready to invest in luxury real estate? Let's hit 1,000 subscribers and monetize Hedge and Haven together. The global cities fueling this boom are a hedge fund's roadmap to wealth. In New York, Billionaires Row saw $2 billion in Q1 transactions, with hedge funds buying $100 million in condos per Zillow. In Dubai, Palm Jumeirah's 8.4% price growth attracted $1.5 billion in capital per Knight Frank. Singapore, Monaco, Zurich, Sydney, Hong Kong, and London remain pillars of stability, with properties yielding 3 to 4% in rent and 5 to 8% in appreciation. Hedge and Haven viewers can invest in REITs like Brookfield or buy directly in these markets. A $3 million Monaco condo paired with a Swiss account could save $400,000 in taxes per quarter. Subscribe now and comment which city is your real estate target. As we conclude this exhaustive deep dive, hedge fund's $12 billion bet on luxury homes in 2025 is a masterclass in wealth preservation. From London's Mayfair to Dubai's Palm Jumeirah, from New York's Billionaires Row to Singapore's Orchard Road, from Monaco's Larvado to Zurich's Gold Coast, these properties shield billionaires from inflation, volatility, and geopolitical risks. At Hedge and Haven, we're empowering you with their strategies. Diversify into real estate, leverage offshore banking, and stay ahead of the curve. What's your next move? Buying a $5 million condo in Singapore, a $10 million villa in Monaco, a $15 million chalet in Zurich, or opening a Cayman account? Share your plans in the comments. Let's talk wealth. Check our video on offshore banking strategies for 2025, linked below. Subscribe to Hedge and Haven and hit the bell to join our high finance community across the USA, UK, Australia, Canada, Germany, France, Norway, Switzerland, Denmark, and the Netherlands. Keep building your wealth smarter, bolder, and faster.